You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. Welcome to Volatility Views, the premier program for volatility traders. My name is Mark Longo, coming to you live, yes, live from the Options Insider Studios here in actually somewhat sunny and tropical Chicago for a February day. Of course, the options mecca of the known world. And for those of you out there who are listening after the fact on all of our various outlets, which is normally the way you guys consume our programs, and you're saying to yourself, what's he talking about live? Well, you can indeed check out the show live via MixLR or Mixler, call it what you will, MIXLR. A lot of you are listening live as we speak. And of course, if you're listening after the fact saying, how do I find that? Well, you can find the MixLR app in pretty much every mobile device, iOS, Android, all that fun stuff. Just download that app, search for us, Options Insider. To search for options will come up, and you'll see when our shows are live there. Of course, we record this program every Friday, noon Central, 1 p.m. Eastern, for all of you who want to tune in, hear how the sausage is made, the rough cut, if you will, before the nice, beautiful, pretty edited version comes out on Monday morning. So pick your poison however you like to consume Vol Views, the nice, raw, rough version, or if you like the pretty edited version. You can have both. We put it all out there. And of course, the latter kind, the edited kind, available on all your favorite on-demand platforms, iTunes, TuneIn, Stitcher, and so on and so forth. Easy for me to say today. And of course, you can always grab our mobile app, available for iOS, Android, and the Fire OS. We don't have the live baked in to the mobile app yet. It's kind of a recent addition. We kicked it off for our big option block 500th episode. Spectacular, and it worked reasonably well, so we thought, why not extend it to the rest of the network? A bit of a rolling pilot, if you will. So let us know if you have questions or comments. Those of you following along in the old chat can ask us that stuff as well. And I am joined on the old program by my usual volatility compatriots, my partners in crime, starting off with the man beaming in from his palatial corner estate over there at the Options Institute, the CBOE Options Institute, Mr. Russell Rhodes, a senior instructor over there. Let's see if the Skype gods are smiling upon him today, if he can hear us. Mr. Rhodes, welcome back to the program. How are things in the land of the corner office?
Oh, Skype gods, thank you for smiling on me.
So we can hear you. So they are indeed smiling upon you today.
Good to know. So I'm just here in my palatial corner office staring down at the horse statue where there are no fisticuffs going on because things are kind of calm today.
It's nice that there's no fisticuffs going on.
To the horse.
At least you can see all the seedy people coming in and out of old Alcock's.
Yeah.
That tinny voice, listeners, is none other than the greasy meatball, Mr. Mark Sebastian. Mark, welcome back to the program. It's been a whole about 24 hours since you and I have chatted live here on the network.
I know, and while it's not the same as being in the room together, it's still good to be on with you, bud. It's good to hear the deep baritone sounds of the longoed voice.
Yeah, Mark got to see the new studio in action in person yesterday, complete with adult beverages and food and all sorts of fun stuff for the big Option Block 500th episode. Spectacular. If you haven't checked that out, listeners, tune in via iTunes, tune in our website, etc. A lot of fun stuff going on. We went a little long on that episode, but hey, 500 episodes. I think we are allowed. And we'll see what we have going on today, because a lot of fun stuff to get to today in our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is indeed the portion of the program where we break down the week that was and indeed still is, from a volatility trading and analysis perspective, activity perspective, all different ways. We carve up the week that was. We are recording this, of course, on Friday, February 19th, for all of those of you who are so unfortunate as to not be able to tune in live, listening after the fact. And we are recording right in the middle of the session, about noon central here. And most of the major indices fairly unched on the day. The S&P off about a quarter percentage point. The Dow off, leading the charge to the downside, off nearly half a percentage point. The tech-heavy Qs rallying a wee bit today, up about a third of a percentage point. And with all of this back and forth, VIX cash taking a little bit of a break going into the weekend here, off about a little over half a handle, right around the 21 level right now. That just sets the stage for where we are right now. Of course, it has been a very interesting week from an underlying perspective, from a volatility perspective. Started off the week, of course, it was a truncated holiday week, so that, of course, plays into the equation where we're talking about volatility. And we kicked off the week on Tuesday this week, the 16th here, kind of roaring out of the gates, and saw a lot of activity throughout most of the middle sessions of the week, as it seemed like the bulls were back in force. And then yesterday gave back a little of that, but not a ton, kind of the inevitable sell-off after the bulls had been rallying for multiple sessions. And then today, like I said, kind of a bit of a fractured setup as we go into the weekend. So a lot to discuss. Volatility was all over the place across the board. Maybe we'll start, we're kind of winding down, Russell, in earnings land, kind of the tail end of the season. We've been talking about a lot of big names making a lot of interesting, surprising moves and performing surprisingly through their earnings straddles and volatility. Didn't see a ton of that this week, but maybe let's kick it off there to see if anything really caught our eyes this week. Anything really drawing your attention? We didn't have a big Google or Microsoft, some of the other names a lot of people like to watch this week. But anything catching your eye on the earnings vol front this week, Russell?
Well, there was nobody really. Yeah, we were going through this period where it seemed like every week we had one of these big blow-ups that you were thankful that you were not in front of, and we just didn't have any of those this week. But it's interesting, I was speaking to an options club down in Florida yesterday, and that's what they said, if we're expecting larger moves out of earnings going forward, and I love how, one quarter of this going on makes them think that this is the kind of thing that's going to keep going on. What should we take a look at? And I was
Russell, are you implying that retail traders have a recency bias? No.
Well, a little bit of one.
I'm kidding.
So. But, the one that's coming out next week that I think might be kind of interesting is GoGo. My favorite part of flying these days, because they're in negotiations right now with American, and I know the stock is all over the place.
Yeah, I heard Americans wants to kick them to the curb.
some people think it's that, and some people think that it is just negotiating out loud. So
yeah, I've heard it's just that.
Out.
I've heard it's just that, Russell. That, yeah, they're definitely fighting with GoGo and trying to squeeze them as best as they can. Let's just put it that way. That's for sure.
So, Mark, I saw you chatting about, I think it was Jack in the Box this morning on the CBOE TV. So you've been watching the food-related earnings this week, eh?
Yeah, Jack absolutely jacked me in the leg. I have, as I said earlier, I have Egg McMuffin all over my face because while, with Jack, my whole thesis was Chipotle stinks. They own Qdoba. Qdoba is going to be a big beneficiary of all this mess. And then, of course, the next thing you know, McDonald's says all-day breakfast, and the flagship Jack in the Box gets absolutely gutted. And we're kind of seeing that across the board. And McDonald's all-day breakfast is shaken up the entire fast food business, and especially those that really did well on all-day breakfast. So Dunkin' Brands and Jack in the Box getting absolutely slammed. I'd be looking at, really their effect on small diners and places like that serve all-day breakfast as really, what they're doing is sending shockwaves across the breakfast verse. Where,
the breakfast verse. I like it.
Never heard the breakfast verse?
We might have a new title for our show, the breakfast verse. Volatility of the breakfast verse. I like it.
Yep.
Who'd have thunk it that McDonald's going all-day breakfast would just knock it out of the park? Oh, wait, everybody. I've been saying that for years. They should go all-day breakfast. It's the one thing I actually like at McDonald's. So the fact that they make it 24/7, the one thing everybody universally likes from them, hash browns and egg McMuffins, etc. Who'd have thunk it that it would actually do well? And sure enough, it has been. So after all their hemming and hawing for the better part of a decade about how they couldn't do it, they couldn't switch their kitchens around in time, whatever excuse they were giving on the day, they finally made it happen. And lo and behold, it's been a great thing for them. And at the end of the day, who are you going to choose for if you're going for fast food breakfast anyway? You kind of know, you can known quantity in your egg McMuffin and your hash brown versus whatever else any other competitor in that realm, in the breakfast verse, as you like to say, is definitely playing catch up, playing second fiddle, moving out of the realm of breakfast. Though we could talk breakfast volatility all day here on the program, quite frankly. It's a beautiful thing. But moving on to the realm of actual volatility, and starting off with ye old VIX, the mothership, the flagship there, was an interesting week. Mark, we were talking yesterday on our Option Block 500th episode, spectacular. A little bit of Contago working its way back into the VIX futures. We haven't seen that in quite some time, so that's interesting in and out of itself. Of course, I mentioned at the top of the show that after all this back and forth this week, after a lot of rallying to this week, we've seen VIX cash out of the beloved demarcation known as the red zone, marked by our friends over there at Goldman, who say pretty much anything north of the 25 handle is red zone, is dangerous. It leads to potential recession and slower GDP growth, et cetera, et cetera. So we're well out of that range right now, hovering south of the 21 right now as we continue recording. So a lot to parse here. Perhaps we'll start with you. Let's talk about that Contago, because it's been a while since we've seen that. And that in and of itself is, I think, worthy of note this week.
Yeah, I think the real interesting piece is that, volatility seems to have calmed down this week. We've finally gotten the curve where, where everything kind of lines up the way you'd expect. It's just happening at 5 to 6 points higher than where traders are used to seeing that volatility contango. And, I would actually argue, if you talk to volatility traders, they say the range where people really get beat in the markets is this 20 to 25 range, where the market kind of flips people's around and throws people around. And so I'm very interested to see how all this plays out.
I think a lot of people are. Yeah, you're right. Certainly north of that 25 level is the area where, Goldman calls it the red zone. I like to call it, I think, more a little bit north of that. I think more in the 30 handle, so kind of right in the middle of that 25 to 35 range. I think 25 is a little bit low myself, but to each their own. Everyone has their own risk-averse level where they think that red line is, the take your ball and go home level, as I often refer to it. I think we've all kind of pontificated on that on the show in the past. But Russell, a lot of things kicking off this week out here. Of course, Contago, VIX out of the much beloved, much mocked, call it what you will, red zone. What really caught your eye out there in the broad volatility space this week?
Well, we went 30 straight days with the front month at a premium to the second month, and when we fell out of it, I just happened to be on a plane and had a little free time, so I cranked a blog out real quick and showed what the overall equity market has done for 30 days, 90 days, 125 days, and 250 days, which is a year, after the end of the 10 longest streaks of front month, second month backwardation we've ever had. And the results are mixed. But what was really interesting to me is when you go out a year, all but one of those 10 longest streaks, the result has been a move of well over 20% either direction.
Oh, wow.
We got like the second longest streak. A year later, the market's 25% higher. When we came out of one of these streaks in February 2008, the market was 38% lower. So even though we've fallen out of a long period of backwardation, these things have been precursors to pretty violent markets, either to the upside or the downside. Nothing directional stood out, but increased volatility post these things kind of stood out.
Well, Russell, you're a man who always comes equipped with data, and we appreciate that. Speaking of data, you guys over there in the land of CBOE have been cranking out quite a bit of it. We talked a couple of weeks back about the weekly put study you guys did on the put index versus the weekly put right index, and the comparing and contrasting of the volatility and the amount of annual premium you can get out of that, and the drawdown, standard deviation, all that fun stuff. Well, not to stop there, you guys also put out a study with our buddy over there, Mark Shore. We've done a lot of stuff with him over there in our Options Alliance group, and he looked at a lot of the Russell indexes and some of the various volatility components and premium harvesting components therein. Of course, this show not just brought to you by CBOE Live Vol, but also by our friends over there at Russell Investments. I didn't talk about RVX so much in here, but he analyzed a few maybe lesser known indices that are disseminated over there on some of these Russell ones. Some of our listeners may not be familiar with them, including the CBOE Russell 2000 Buy Right Index, or BXR, kind of like the Russell version of the BXM. The Russell 2000 Zero Cost Put Spread Collar Index, aka CLLR. The Russell 2000 Conditional Buy Right Index, aka BXRC. The Russell 2030 Delta Buy Right Index, you can kind of guess what that one is, BXRD. The Russell 2000 Put Right Index, aka P2TR, and the Russell 2000 One Week Put Right Index, which is WPTR, which is kind of a similar flavor what we talked about a few weeks ago. And he found a lot of interesting studies. We'll kind of just hit on the highlights for it. We'll put a link in the show notes, listeners, if you want to find it yourself. The full study title is called Analyzing Russell 2000 Index Options-Based Benchmark Indexes Designed to Provide Enhanced Yields and Risk-Adjusted Returns. Talking about those returns, of course, as you said, a lot of other data we've talked about in this and other programs on the network. These strategies, particularly premium harvesting, writing type strategies, get painted with this broad risk additive type brush. But if they're done in the proper fashion, they can actually deliver decent, in fact, in this case, higher risk-adjusted returns. One of their findings here, they found that the put right index, PUTR, since 2001 had higher returns and lower vol and a higher Sharpe ratio than both the Russell 2000 itself. So if you just went out and straight up bought the Russell 2000 over that period, or a Citigroup, a 30-year Treasury bond index, that'll probably surprise a lot of people who continually view that strategy of just writing puts as being, analogous to Russian roulette out there in the marketplace. And then, of course, we talk a lot here on this program about the volatility premium out there in the marketplace. Of course, the difference between implied and realized volatility, and how, in general, something like the Russell, which is small cap based anyway, should be more attractive from an overall volatility premium perspective. And he found that that may indeed be the case. They are very rich out there in Russell land. So since 2004, implied vol out there averaged a little bit under 3 volatility points, about 2.89 volatility points higher than realized, which is fairly rich. We talk a lot here, again, on the typical, S&P volatility premium, aka the risk premium that we see out there in the marketplace. Haven't really talked a lot about it in a Russell context. So it's kind of interesting to see that broken out there as well. And of course, they hit on the same note we kind of touched on last week or a couple weeks ago with the weekly option study, where we talked about annual premium with writing weeklies versus writing monthlies. A lot of people think, monthlies are where the action is because the premium is more, but surprise, surprise, if you do something 52 times versus 12 times, even though each little drop is going to be less, over time it adds up. And of course, that also talks about what we said on this show many times before about maximizing your exposure to that near exponential portion of the theta decay curve and all that other fun stuff. His study found that the aggregate gross monthly premium, looking back at 2015, was 41.4% for the weekly put right index in the Russell versus only 22% for the regular put right. So that's a stark difference. You're talking almost 2x returns going weekly versus monthly. That's very, very surprising there that it's that. I don't think it was that high even in the S&P, showing that there's some interesting things afoot out there in Russell. And so a lot of other things to take away from this study. I'll let you guys look at all of the takeaways for yourself. Those are kind of a few that I found very interesting. Also, maybe worthy of note for you checking out some of these indices out there because they're not as widely tracked, not as widely followed. Maybe interesting.Maybe find something you like out there if you're looking at things and indices and things to track and watch in Russell land. Russell, talking about you to you now, not about Russell, the firm, even though it does get confusing sometimes here on the program. I'm sure you've seen this study. What's your takeaway on some of these interesting data points? Some of them kind of corroborate what we've seen in some of the other studies with the weekly. Some of them are interesting in and of themselves, just pulling out some interesting nuggets from Russell products. Any takeaways from this study that really caught your eye?
Well, a takeaway, and it's something that I'd done some work on in the past for the academic program I'm in, where I had noted that the implied volatility of RUT options is typically a little bit more overpriced relative to the realized volatility when you compare it to SPX and VIX. And, we continue to see when we get big price moves in one direction or another, we continue to see out of the money call spread or out of the money put spread sellers. And that's what I really like with respect to looking at the at the volatility behavior. That's what stood out to me the most out of the papers that we've gotten out so far. There's actually, my understanding is we've got 2 more papers coming out over the next couple of weeks as well.
Yeah, there's a bunch more to come, so we'll hear a lot more data. For those of you out there who love to have some data, either for your own trading or to sit down and talk to your clients about, hey, this is why we use options in our portfolios, whatever the case may be. More data is always a good thing, and they got a lot more coming. You guys at CBOE have really gone overboard when it comes to data, and we'll be down at the Risk Management Conference over there in a couple of weeks. We'll probably catch up with a few of these studies office. I know we're going to talk to Mark at the very least there to see what's going on, get a little bit more insight into this Russell study. We'll see if we can catch up with some of the authors of a few of the other studies if they're going to be down there and get a little bit more insight into their findings as well. So a lot of cool data coming down the pike. Mr. Greasy Meatball, anything catch your eye in this Russell study before we move on to all things VIX options?
No, I mean, is anybody surprised that with the weekly options return more? No. But there's also, one has to think of the idea of risk reward of trading weeklies, not just in what the return is, but what's the risk adjusted return. And, while trading weeklies has a higher return, I'd be interested to see what that does to kind of relative portfolio volatility and, what that does to just in terms of time adjusted return as well. I mean, how much time do you have to spend doing one versus the other? So, a lot of people say weeklies, and then there are other factors that are mitigating on that, and so that's just something to think about when you're trading this stuff.
Yeah, that particularly for this one with the Russell number, that is just such a stark difference between the monthlies and the weeklies. I think there's probably more to dissect in there. Maybe we'll have a chance to do that at some of our upcoming episodes. Meanwhile, though, it's time for us to dive into all things weekly with Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
All right, listeners, you know what that fun little snippet means. It's time for our friend Russell, not Russell Investments. Oh, so confusing it is, I know. But our friend over there in the corner office to break down. He's always watching. The man lives and breathes naught but weekly VIX options. He's got his finger on the pulse of all things weekly VIX. Mr. Russell, Mr. Corner Office, what caught your eye in this week's activity, sir?
Well, first off, when you play my intro music, we're going to have to make a video of what I do, because I actually sit on one of those exercise ball things in my office and I bounce up and down to the music.
Oh, so you get a little exercise in, a little dance.
Yeah, it's just, it gets me all fired up about weekly. You know, weeklies in VIX, it's like, you know, peanut butter and chocolate all together. Today in the weekly space, somebody is buying the March 2nd 29 calls and paying 24 cents for those. So somebody is either guarding against or expecting, you know, a VIX move between now and the first Wednesday in March up above 30, because that's pretty much what you would be expecting or hoping for if you were going to do something like that. And then I actually saw another trade that was kind of interesting to me, and it just actually fell off my screen. Somebody came in and did a synthetic long with the March 23 20 strike calls and 20 strike puts, and then they sold the 28 calls against it. And I had it on my screen, and then a couple of big trades came in, and it dropped off a little bit. But I thought that was kind of interesting, because they're basically doing doing somewhat of a buy right, and maybe protecting if VIX gets down to the high teens, they're still going to be okay with that trade, but they can benefit up to 28 if we get any sort of spike in volatility. And choosing the March 23rd options, which are the week after the standard March expiration, you always think somebody's got some sort of event in mind when they pick a date like that.
Yeah, definitely. I was looking at some of the paper you're talking about. And by the way, it's an aside. I love the weeklies. I love the advent of the weeklies. I love the fact that more are coming. So there's more trading options out there, literally, for people out there. But I think we do have to find some way to make the nomenclature a little bit more penetrable for people. Sitting there saying March 2nd, weekly 16, it's just obtuse, and the more we add, the more obtuse it becomes. I even find myself stumbling. Wait a minute, which one am I looking at right now? I can imagine a lot of the retail in particular out there have to be just falling over themselves in terms of actually knowing which strike, and we put the weekly before the strike. It's a lot of things I think have to be sorted out there. Maybe that's more of a question for the OCC and the symbology folks, but I know we hear that reiterated a lot from a lot of our listeners as well. So I thought I'd just put it out there in case you're one of the people out there who's just overwhelmed by all the nomenclature and verbiage we're always throwing around when we're talking weeklies. But yeah, a lot of stuff kicking off, and you're right, Russell. It is kind of interesting to see people focusing on that specific date as opposed to, let's say, regular March, something else. And they pick that kind of obscure of I think I'm looking at it right here, some of your synthetics versus the 28s. It was the 20. They did it looks like about 2,200 times on the weekly 23rd 20s in March versus the 28 calls. So interesting stuff there as well. And of course, regular March are in the weekly realm as well. About 42,000 of those March 35s going up today. So a lot of stuff kicking off. We'll get to that. It was an interesting week overall from a VIX options perspective. Strong start coming out of the gates here after the holiday weekend. Probably a lot of that having to do with just of course, the underlying movement in the indices, as well as maybe it's just some pent-up demand from the fact that the markets were closed on Monday here in the States. So we kind of got a bit of a 2X day there on Tuesday, perhaps as a result, with nearly 1 million contracts, over 900,000, going up on Tuesday, Wednesday, and Thursday, both hovering around the ADV, around the 5.5 million or so contracts. And as we're kicking off today, we're about halfway through the session here, about a little over 250,000 contracts having gone up. So it looks like we're probably going to be in that same ballpark again today. Not lighting it up for the end of the week, but kicking it off pretty hard at the top of the week, start of the week. I also saw some weird paper going up throughout the week. You can kind of pick your poison as which strikes were kind of lighting it up. We saw people buying some upside out in May. as of yesterday with 15,000 of the May 32 halves going up, paper gobbling those up for about $1.57 or so. Also saw, it looks like, I couldn't tell if it was a bit of a strangle or a risk reversal going up yesterday, but it went up at least 26,000 times on this March 22, 26. I know they bought the 26s. I'll have to dig in and see what they did on the 22s there on the puts. If they bought it both as a strangle, if it was a bit of a risk reversal, what was going up there. But it looks like they traded the 22 puts for prices around $1.60 or so, and then the 26 calls, paper buying them for prices around $1.27 or so. So they either netted them out or they bought them both. We'll have to dig a little bit more. Either way, though, kind of strangles and broad trades seem to be kind of the order of the day as well. It also looks like something funky out there. 18-19 put spread going up about 25,000 times in March as well on Thursday. Kind of paper across the board. Upside seemed to be more the order of the day on Wednesday, which is kind of interesting considering the fact that we were in rally ho mode and the underlying things were coming off. Maybe people taking the opportunity to scoop a little bit of paper when they were cheaper, including the March 40s, the ever optimistic. That's well beyond. We were talking red zone, the 25, maybe the make or break point around the 30. Certainly 35 is where everyone takes their ball and go home. Our friend here loading up on the 40s out in March, 25,000 times for an even quarter. We also saw, looks like a bit of a funky strangle. I think it was a pretty tight one. March, I think it was 24, 25, going up about 12,000 times. I believe it was paper selling. Mark, I think that one came up on your radar as well as you were looking at some VIX paper. Aside from that strangle, of course, is interesting. And anything else out there catch your eye this week when it comes to VIX options paper, Mr. Greasy Meatball?
Yeah, we're seeing some big call buying. I mean, anytime you get a dip like this, you start to see some people pack. But the other one was huge buyer, the March 19 puts, which was kind of interesting. Not sure if he was hedging. That absolutely could be a great hedge against a short position. But we did see the March 19s in VIX have just a ton of volume the last few days. If you look at that open interest, I mean, it's the 20s and the 19s and the 18s have huge open interest now, and at the put strike. So if you look, the 18 puts have 115,000 in open interest. The 19s have 85, and the 20s have 180. So you got huge upside open interest. Then you got some players starting to bet on volatility, maybe backing off. So it's kind of interesting.
Yeah, we don't really see a lot of puts lighting it up all the time, so that's always worthy of note. And we certainly highlight those whenever we talk about the hot strikes lighting it up in VIX this week, and we'll hit on a few of those in a few minutes. We also saw, worthy of note, too, a little bit farther off paper earlier in the week as well. In particular, it looks like some May upside going up. The May 28-32 call spread seemed to have been a popular one. Paper gobbling that up earlier this week for about 88 cents. So there was still some upside love to be found out there, even though, particularly earlier in the week, we were seeing a bit of an inhale, shall we say, out there in volatility land as everything on their mother was in rally mode except for volatility. So interesting stuff across the board. A lot of interesting paper. That strangle is kind of interesting as well. Pretty tight. I'm not sure what would behoove someone to want to get into one of those, but we can get into that as we move into what the hot strikes were. You kind of touched on this a little bit, Mark. Puts, a lot of puts in the top 10 this week. 3 of our top 10 strikes coming on the dark side, the put side, starting it off. Number 1, the March 30 calls. No surprise, VIX upside optimistic calls still leading the day, about 400,000, almost exactly open on that strike. So that still is the strike du jour. That blows pretty much everything else out of the water. The number 2 strike, a little more than 250,000, about 268,000 of the March 35 calls. A little bit more optimistic, but to nowhere near as much paper. Then about 205,000 of the March 27s, getting a theme here, listeners. Then the March 40s with about 189,000 open there. Number 5 is where we find our first puts on the list, the March 20 puts that Mark was just talking about 179,000 open on that strike. Number 6, the March 25s with about 150,000 open there. Then the March 26s on the number 7 list, the number 7 on the list, I should say, with about 132,000 contracts. Number 8, the March 23s, so thematic across the board, pretty much all March and all calls for the most part, except for a couple of puts here and there. March 23's number 8, March 26 is number 7, 132,000. March 23 is number 8, 128,000. Then the last two winding it down with a couple of puts on the dark side. The March 18 puts with 115,000, and the March 22 puts with about 114,000. About nearly just a tick under 5 million contracts outstanding overall there in the old VIX Options suite, about 3.4 million on the calls, about 1.6 or so on the puts. Again, nothing out over the ordinary there. Of course, if this put paper continues, then we may see a little bit of a diminishing of the overall call heaviness in that VIX call to put ratio, which is always pretty strong. Right now, it's actually hovering at a fairly low level, only about 2.2 calls over puts out there in the open interest. And you know, if you followed VIX, and they can easily get up into the 3s and the 4s when people start really loving themselves some upside calls. So 2.2 calls over puts is actually fairly low. Again, reflecting all that put paper we've been seeing of late out there in good old VIX land. Let's now turn our attention to some other products that exhibit a wee bit of volatility out there. Let's start with the black stuff, the Texas tea. We saw a lot of action out there in crude this week, a lot of it driven by the rumors. You know, people have been talking ever since this sell-off began over a year ago. When was OPEC really going to step in and start curtailing some of their production? It seemed like a no-brainer. If they really wanted to support the price, they just dial it back a little bit on the spigot, and there you go, support the price. And surprise, surprise, they never really did. There were a few rumors a few weeks ago about Russia perhaps colluding with a few others to try to curtail the supply a little bit. That all came to naught. Now we're starting to see perhaps rumors with a little bit more meat behind them that perhaps indeed there will be some action on supply, which has kind of been the main problem. You know, price continued to drop, and they continued to pump out the same amount, if not more. And so, of course, price continued to drop. So if we see some action there, that may indeed finally be the catalyst that could turn around. Of course, we've been saying that for quite some time now in crude, and it hasn't really happened. We did see that initial rally out in crude kind of falter somewhat, so people were really buying into this rumor. Then it seemed to kind of have lost a little bit of its legs. So we'll see if anything really materializes out there. Of course, going into last week, like we said, there were some serious spikes out there in oil vol with about a 7-year high out there when you're talking about products like OVX and OIV. This week, they're hovering, still elevated, hovering around a 67 level, so off of the mid-70 range that they were bouncing around last week, but still extremely elevated, certainly when it compares to, you know, the mid-40s to 50 handle where it was typically hovering around in the last few months prior to that. And looking at the old skew, even though all this talk about a rally, all this talk about curtailing production, and if that's finally going to be the pop we see, there is certainly some life in the call skew out there, looking at across the term structure all the way out to about Dece of 2016, but nothing perhaps as sharp as you might expect given the rumors floating around out there that some action is imminent. There still is a market premium to the puts on the downside going all the way here. I'm looking at this chart here on like the 21.5 and 24.5 strike out there, all the way out to like Dece of 2016. So people are still prepared for some market downside in crude for this foreseeable future, which is very interesting. Maybe we'll start in the corner office. Russell, I know you're mostly on the VIX weeklies, but every now and then you cast your glance a little bit further afield to some of the commodity stuff. Anything catching your eye out there in crude land this week?
Well, the folks over at Yahoo Finance asked me to do a little digging on oil volatility and try to get an idea of what it's telling us. So Tuesday afternoon, I was looking. I saw that the skew was still to the downside, and implied volatility is elevated. And I said, you know, it looks to me like everybody's pretty concerned about a downside move still. And lo and behold, the next day, crude rallies like a madman. So
it's always that way, isn't it?
Yeah, I thought, and of course they didn't put the video out until Wednesday as well.
Oh,
but
that's what we call the Russell shame index. You know, the higher it gets, the more of an inverse correlator that is.
Next time I'm getting ready to say something about energy anywhere, I'll let everybody know so they can do the opposite. But it still back when we were in the upper 30s, we had 2 or 3 instances where things that seemed like they should have fundamentally gotten oil going to the upside failed. And I think we've seen it again. So kind of sticking with that bearishness, at least for the meantime.
Yeah, that certainly seems to be the case. How many times have we said now, maybe this could be the thing that finally is the inflection point, and they all pretty much have withered and died on the vine, which is, it seems like at least that rally we saw was kind of, you're right, it was that one day just enough to embarrass you, but it didn't really have the legs a lot of people perhaps thought it would. Mark, anything catching your eye out there in the realm of crude oil volatility this week?
Yeah, we saw it hit into the 80s last week. It's just been off in crude vol. And while I think oil could go lower, I think vol has topped out. And so I think that we're heading for kind of a slow move lower in oil volatility, followed by, who knows, some sort of bottom forming. So, as you know, volatility tops don't match up bottoms, but I think we're starting to form bottom, and I think we're at the top of the ninth, if you will.
Yeah, it certainly seems that way, from a vol perspective, but you're right, from an underlying perspective, it is anyone's guess as to what the driver will be going forward out here. But again, looking at the skew, it seems like puts are where the concern is right now. Moving to the shiny stuff, which has also been moving a wee bit of late. We talked last week on the show that people pretty much couldn't get enough gold calls. That's where all the action was. You could do, verticals and things for levels that were kind of absurd. It's still the case out there, lessened a little bit perhaps, but still the case, particularly in the nearer term, the front months. The skew is almost a straight line up and down. There's really very little subtlety or slope to be found there. You go a little bit farther out, obviously a little bit cooler heads prevail. They're still very steep as well. A little bit more love for the puts this week than we saw last week, but still the focus is still primarily on the call end of the spectrum. GVZ, the old gold VIX, hovering right around 25.5 or so, a little bit off where it was last week, but still extremely elevated compared even to a couple weeks ago. So a lot of people still interested, a lot of people driving the vol up, still out there in gold land, even though perhaps not quite as sharply as this time last week. Russell and Mark, anything catching your eye out there in the shiny stuff before we give our listeners a chance to join in here on the old program?
We've got GVZ's been real stiff, and but that's been about that. That's really been about the most exciting thing we've seen is that there's been relatively stiff GVZ.
That always is an exciting thing, relatively stiff GVZ. Speaking of excitement, let's turn the tables now on you guys, the listeners, give you guys a chance to come on the old show with a little bit of our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the volatility voicemail. This is the portion of the show where you guys take the reins with your questions, your comments, your insights, not just for us, but for your fellow volatility views listeners. Like the man said, you can get at us a variety of different ways, the app, the website. We're adding now the MixLR chat room to the mix, so if you guys are going to be tuning in live down the road, one of the extra benefits of you guys tuning in live, whether it's via the app or via the Mixlr site as well, is you get a little chat room where you guys can follow along with the show, chat with fellow listeners as well as with us here on the show. So if you're going to be tuning in next week, noon Central, 1 p.m. Eastern, let us know. We'd love to hear from you guys in the chat room with your questions, your comments, your feedback. You like me, maybe you don't like Russell, etc. I understand how it works. Either way, let us know. We'd love to hear from you guys. Kicking off really quick, our question of the week, driving a lot of interest again over there with a lot of our listeners. This week with the launch of ISE Mercury, of course, bringing the total number of options exchanges to 14, we decided to ask our listeners, hey, what do you guys think of all these options exchanges? Good thing, bad thing? We gave them the choices of 14 14 is perfect. The more the merrier, make it stop, or other, and they get to explain themselves. And as you might expect, only 5% saying 14 is perfect. 30%, probably a lot of the exchange officials in our audience saying the more the merrier, so they want more exchanges. But a resounding 60% saying make it stop, and only 5% choosing the other there. So no love for 14 exchanges out there. Perhaps not really surprising. If you guys want to participate in that, it still is running. I think we got another day or so on it on the old Twitter. So if you're not following us, twitter.com/options, and you too can make your voice heard. We got a couple of interesting questions. Let's kick this up. This one is a popular question, and I'm guessing it's only going to become more common and more popular as the year progresses. This one comes from George K. He writes, what typically happens to volatility around a presidential election? We're starting to get these questions now with, of course, we're in primary season here in the States, moving into the big election cycle in November there, and it's kind of a lot of people's eyes on what may happen as a result. It's kind of a bit of a mixed bag when you look at volatility overall in terms of an election. It kind of depends on what kind of race is shaping up. I guess, if you have one of these relatively predictable elections where there's maybe an incumbent president and there's a really long shot candidate running against him, and it seems like one candidate is demonstrably ahead in the polls for the better part of the entire electoral cycle, and at that point getting into the election, probably you can have a little bit of volume premium, obviously, because there's always a chance of unknown. It's kind of like a bit of a muted earnings event for the entire market, but pretty much the market's going to have baked that in. If you have more of a contentious electoral cycle, let's say you have two candidates on two very polar extremes when it comes to financial type topic. Let's say, for the sake of argument now, let's say we have going into the November season, we have Trump on one hand and Sanders on the other as the two leading contenders, the two major party candidates, and they're neck and neck in the polls going into the election. Well, that could be a very volatile event because either one of those two getting elected will have marked different outcomes for the economic outlook for the country. So as a result, we'd see a lot of volatility going into that, and certainly as a result of the outcome. I remember being down on the floor back in probably the most heated and contentious electoral cycle, which was, of course, the big 2000 Bush-Gore fiasco, and that lasted for months or over a month after the election, and there was implied volatility all the time. For pretty much every day, the market would rally, it would sell off based on who was leading in the recount in Florida, and it was a very turbulent time. I don't expect that to happen again anytime soon, hopefully. But that was kind of probably the extreme when it comes to volatility. But it certainly kind of really depends on how the landscape shapes up. Right now, it's still very early. But that said, I'm guessing our friend over there in the corner office, he likes his data. He likes to do little studies. I'm guessing one or two people may have asked you this question, Russell. So I'm guessing you may have a little bit of data on this. So what do you have for our friend here, Mr. George, who wants to know what cooks from a volatility perspective around election time?
Not a lot. It's kind of what you just said, that with the exception of the 2000 election where we had some uncertainty afterwards, one of the things with all the polling that we have going on in the United States is we usually have a pretty darn good idea of who's going to win this thing before the election actually occurs. And also and I really try hard to avoid politics, but typically when you get middle of the road candidates from both parties, there really isn't a whole big difference between the two. However, I was fortunate enough to be in India when they launched the India VIX futures, and they launched the India VIX futures when they were going through an election. And that election was a complete crapshoot. And for almost a month leading up to the election date, it didn't matter what the stock market did. The implied volatility, or the India VIX, moved higher almost every day. So, if you're in a country like India or Brazil, and we had the same thing with the Brazilian volatility index for their last election, it just kept moving higher, regardless of who they thought was going to win, because it was more of an uncertain earnings event than what we get in the United States. It's almost like the U.S. is a boring old utility stock reporting earnings, and some of the emerging economies are more like brand new internet stocks, then we don't know what they're going to do.
I like that. There is certainly a lot to be said for that, and certainly we do have perhaps an overabundance of polling and data here in the States. Doesn't mean we really know that often who the heck's going to win. I recall the Bush-Kerry election. We're going into that, and even early exit polls, a lot of people were saying Kerry was the winner, and then sure enough, that didn't really turn out to be the case. So it doesn't mean we're always right, but yeah, you're right. I think just the prevalence of data out there kind of tends to mitigate a lot of the volatility effect that you otherwise would see in a lot of these developing countries like India and things, where it is a little bit more of an unknown, and as a result, you see a little bit more vol out there. Who knows? If you want a little bit of vol, if you want to trade a little bit in the red zone, then perhaps you're pushing for a contentious Trump-Sanders runoff right to the end there. And if you're maybe you want things a little bit more staid, maybe you want something a little bit more, a little less contentious, perhaps out there. Either way, interesting stuff. Good question. I have a feeling we haven't seen the end of questions about elections and volatility. I thought I would tee it up for us now, and I'm sure as we approach the actual event itself, we'll do a deeper dive into that. But still, it is a good topic, and it does kind of depend on the year and the season and how it's shaping up. There's a lot of things that go into the context. There's no real broad way to describe it, but that's kind of in general how it plays out. There's a lot of it driven by the context. It's interesting to see how we see with other countries, and they start adding things like VIX futures and things. We can start tracking that a little bit more easily in other countries as well. We'll see how they play out. It might be interesting to have a little bit more data on this going forward. But yeah, either way, we're all kind of watching and waiting as the electoral season kicks off in a very strange way so far here in the States, and more certainly to come. As we keep on rolling into our final segment, it's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball, the most dangerous part of the program here. We attempt to divine what those ever mercurial volatility gods hold in store for the week to come. As we've seen from the outcomes of our previous segments on this, it's a tough challenge. Going into the end of last show, Russell was on the high tip. He was saying pretty much put me higher than everybody else. So I marked him down for 35. No, I'm just kidding. I put him above pretty much 25. I gave him a nice safe estimate there. I think Mark was leaning in the low 20s range. He might have even said I think it was going to break 20 at one point. And I think I was saying a little bit less, or about where it was, about 23 to 24 range. And as we are closing up the show here, VIX Cash hovering right about 20.8 or so. So we have to, I think Mr. Greasy Meatball, even though we all were over, so Price is Right, we all lose. But in terms of closest, we have to give it to the Greasy Meatball in terms of proximity. So that gives you, sir, the dubious honor of getting to go first for next week. Where are you feeling in your gut, your heart of hearts, for VIX Cash this time next week?
I think it's going to be higher. I wouldn't go. I think we're in a range where now the market is going to bounce between 20 and 20, 25 VIX is going to be a sale, 20, anywhere near 20, and it's going to be time to buy. And I like VIX to get back up to 25, 26 on Thursday before backing off Friday. We'll say 24.5 on Friday. And what I said last week was it was going to threaten 20. And I would say that 2073 is a threat of 20, wouldn't you?
I'll give it to you. Price is Right rules are tough. I know those are hard to go by. At that point, we should all just bid 1 point and just be and then go from there. But that said, Mr. Russell, you were feeling the love for vol last week, not so much this week in the marketplace, as we are indeed, as Mark said, threatening 20. So where are you feeling for next week?
I was wrong. I was so wrong. And it takes a big man to say he was wrong. Do I get to go lower than Mark this time? Since you guys made me go first last time too.
Because you won last week. That's the dubious.
Mark Sebastian has noticed this, but somebody always seems to get to pick last.
That is true.
That is true. I'm the host.
That is true.
But we've changed it up though. The person who wins gets to go first.
Okay. Well,
it's the dubious honor of going first.
That's why Longo's always going to have to go last.
If you want, I'll go first. I usually go to last. That way I can balance out the picks. I play the host game so I can make it interesting for our listeners. Because if I just come out first and I agree with you guys, then it's no fun. We're all saying 30 or whatever. But if I get to mix, I get to do a little crossfire and mix it up. So we have a slew of data points for our listeners to choose from. See, there's a little bit of host science going on behind the scenes there.
All right, no more scrambling here. So I'm going to go to the other extreme this week. I think we see a 2016 low at some point, which would put us in the low 19s next week.
So low 19s for you. Wow,
yeah,
that's aggressive.
There's not a lot on the horizon until I think the next employment number, if I'm checking my calendar correctly.
Well, I believe the one thing to look out for is that Chinese New Year will be officially over, and everybody really comes back to work on Monday overseas.
Oh, that's why they don't return my emails. Okay. Yeah, that's true. We could come in. We could see some nasty stuff going on if somebody got in trouble because they didn't get the GI Joe with the Kung Fu grip for their kid for
Chinese New Year. Yeah, that could be a problem. Yeah. That could be a real problem.
So we got a tight strangle on out here in the crystal ball with Mark leaning 24.5 and kind of above, and Russell saying low 19s range. So that gives me a tight strangle market that I kind of have to work. I'm not feeling any love really beyond 25, so I'm not going to go too far beyond Mark, and I'm certainly not feeling south of 19 with Russell. So that leaves me somewhere in the middle of that strangle to work with. So to give our listeners some love, I'm going to bifurcate. I'll go in right around the let's say we're at 2083 right now. I'm going to say right in the 21.5 to 22 range, I'm going to say. So there we go. I'll put myself in that tight range. I'll give some nice specific numbers so that people, as opposed to Russell and his ever popular ranges, and we'll see how it comes up next week. And if we'll see. And listeners, start sending, now that we have the live chat, we'll have to start getting our listeners in on the crystal ball going forward with some of their prognostications. Maybe they want to keep their heads down this segment because it is ever dangerous, ever scary. And of course, unfortunately, the end of this segment brings an end to this episode of Volatility Views. But before we go, as always, let me check back in with my cohorts here, my partners in crime, to see what they have cooking that may interest you. Starting off with you, Mr. Corner Office. I know we have a big conference coming up in a few weeks there on the 29th, starting the Risk Management Conference. Give us a little bit of a rundown on that, as well as whatever else is kicking off in the land of CBOE Live Vol.
Going on before I go to risk management, I'm going to Traders Expo this weekend in New York. We're doing.
You have my condolences, sir.
Yeah, myself and Kevin and Roma are going to do a half day on Monday at Traders Expo. And then I'm actually going out to see the Orange County Option Trader Club next Saturday. And I come back. But I've started calling it, I'm pulling a Ben Carson, because I'm going to come home for less than a day, change clothes, and then head down to risk management with you guys.
All right. Well, I'm looking forward to risk management. That's going to be a blast.
Listeners, we'll have some great content. We'll have some great content coming from risk management. Look forward to that. We'll let you know soon when we have more of our schedule set up for that. But before we do that, Mr. Greasy Meatball, I'm sure you're not going to New York. So what's cooking in the land of Carmen Line and or Option Pit?
Well, Carmen Line, we're just got done with a nice trade and looking to get back in. I'm quietly cheerleading a pop and vol so I can sell into it, and I'm quite honestly looking forward to the week ahead. But we got our beginner boot camp. So if you like vol but you don't really get options, go to the beginner boot camp and you can learn all about how to trade options from the beginner. Go to optionpit.com/events and you can check out everything we've got going on.
All right, surf on over there, listeners. And while you're surfing, don't forget this show brought to you by our friends over there at CBOE Live Vol. Surf on over to livevol.com. You have a question about where we get a lot of this data we're talking about throughout the show. Well, we pull a lot of it from that platform, all the historical vol, the realized vol, all that fun stuff we talk about here on the program. You can get it over there at livevol.com. You even get a free trial, so go for it. Kick the tires. It costs you nothing. You got nothing to lose. And, of course, our friends over there at Russell, not the corner office man, but Russell Investments, a.k.a. Russell.com. So surf on over there to kick the tires, learn more about all the new derivatives and volatility products that they're launching over there. And on behalf of the Greasy Meatball and Mr. Corner Office, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing. And now, of course, for tuning in live. We'll make this a regular thing here for the Volatility Views program. And we'll see you next week for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.